Hey Future Millionaires, this is Phil from the Next Chapter team, and in this ETF review video we're going to go over 4 ETFs. We're going to see what are in these ETFs, then we're going to show what your account would look like if you invested in these ETFs in the last 5 years or even the last 10 years. I think we're going to be surprised to see what the new balance will be. Also, please take a moment to like, subscribe, and share. And you know what? Drop a comment. If you think we should be doing an ETF review on an ETF that we've missed, let us know. Give us that symbol. We'd be more than happy to put together a video as soon as possible. Jumping into this ETF review, we're going to cover what an ETF is and how do you buy ETFs. This review, we're going to cover 2 iShare ETFs, 1 Spider ETF, and then finally a VanEck ETF. This is one's a sector one for semiconductors. Starting at the top, an ETF is an exchange-traded fund, which is a basket of securities. So it's a big grouping of stocks, very similar to a mutual fund, except ETF prices change all day. So a share of an ETF prices changes all day, just like a stock would, which also leads it to have lower expense ratios and fewer fees and lower brokerage commissions. Now, how do you buy ETF? Typically, ETFs are available in an IRA or a brokerage account. Every now and then you will see an ETF in an actual 401k, but typically you don't nowadays. But as companies progress more and more, I'm hoping to see that change for everybody. From there, you decide which account do you want to, either an IRA or a brokerage account. Then from there, you open an account with an investment company. That could be Webull, Fidelity, TIA, Charles Schwab, etc. All the big names have these. E-Trade. Then you decide on your frequency of how frequently you're going to buy your ETFs. We recommend usually go with as close as possible to your payroll cycle. So if you're getting paid weekly or bi-weekly, just try to invest with that same consistency. But of course, for every person, this is different. It depends on their budget. Then step 4, you make those transfers to your investment account, whether it be, again, an IRA or brokerage fund, automatic, and then you make your purchases automatic. By doing that, you reduce the human element from it, and you are buying on a regular basis. And that way, you are investing on a regular basis, and then you're enjoying the highs and lows of the investment. So when the ETF goes low in price, you're buying it on the cheap. For each ETF, we're going to do a quick recap, confirming the ETF category, fund benchmark, fund summary, expense recap, top holdings, and overall fund performance. Starting out the list is our iShares Russell Top 200 Growth ETF that goes by IWY. And this one is a large cap. Its fund benchmark is the Russell Top 200 Growth Index. This ETF is seeking to meet the stock price or even growth performance of the Russell Top 200 Growth Index. So that's a subsector of the Russell 2000. So it's going to have the top 200 in there. The expense ratio is really low at 0.20. So that means for every $10,000, it's only $20 per year. Now, what's in this one? Your top 10 holdings of the 110 stocks in there, top 10 will include Apple, Microsoft, Amazon, Nvidia, Alphabet Class A, Meta Class A, Alphabet Class C, Tesla, and Eli Lilly and Broadcom. And sectors in this one, look at that. Overall, information technology makes up close to 47, actually 46.5. Consumer discretionary 16, communications 12, healthcare 9, financials 5.9. And then you can see the rest. But look at that performance. All right. The performance, the 1 year is 46.2. It was a big year last year for this sector. 3 year, 10.38, and 5 year, 20.6. 10 year, 15.85. And that's since inception of 16.8. So that means if you held on to this fund since the very beginning when it first started trading, you would have a since inception return of 16.8. Next up, we're going to review IWP. So this is our iShares Russell Mid Cap fund. So this one is strictly with the mid cap stocks. So this one indexes off of mid cap companies, which are companies that have a valuation of $2 to $10 billion. And then it's looking to have about 47% of its stocks from the mid cap growth index, and then the expense ratio of 0.23. So that means for every $10,000, you would have about $23 of annual expenses. Now jumping into it, what's in this fund? We got top 10 holdings of its 333 stocks. Top 10 would include CrowdStrike, Apollo Global, Dexcom, Cintas, Index Laboratories, Ross Stores, Coparts, and Ameriprise Financial. Look at that. There's a financial company in there. And sectors included 23% in information technology, 19% in industrials, 18% in healthcare, and consumer discretionary of 13%. Financials make up about 10%. And I'm just going to leave it there. You could check out the rest, but they're all less than 5% from there. What do we have for performance? Amazing. 1 year performance for those 333 stocks, 1 year performance was about 25.63. 1 year, 1.12. That includes some big negatives that occurred in year 2. But then your 5 year, if you held on for all 5 years, your average return per year, 5 year blended average would have been 13.58. 10 year, 10.35. And then since inception, again, so these are blended. It takes all the highs and lows. Since inception, 8.86. So pretty good. For mid caps, this is not bad. This is very interesting returns for this one. Moving on to our next one, we're going to cover a spider. Okay, let's look at this spider. This goes by SLYG. So this is a spider, small cap 600. This one indexes off of the S&P small cap 600 growth index. And it has expense index of 0.15. So the expense ratio is 0.15. So for every 10,000 you have invested, you'd have annual expenses of roughly 0.15. Now, let's look into what are the top 10 holdings. And in this one, you've got a total of 343 investments. But your top 10 include Elf Beauty, SPS Commerce, Applied Industrial Tech, Heritage Homes, eSigns Group, Mueller Industries, and Bose. And then industrials, let's look at those sectors. You got industrials leading the pack. Consumer discretionary is up next. Information technology in next at 14.7. Healthcare making up about 11%. And then financials about 10.95, so close to 11%. And then from there, finally, you got materials and energy, both close to 6%. And now let's take a look at those returns. Looking at those returns, so the 1 year for those 343 stocks, 1 year was 17.02. 3 year is 4.14. 5 year is 10.28, and a 10 year of 8.8. And again, that's for a nice low expense ratio of 0.15. Moving on to our very last one. This is a VanEck sector play. This is a VanEck semiconductor ETF. This one's strictly technology and semiconductors. The benchmark is the semiconductors sub-industrial portion of the S&P total market index. And then this one is seeking to completely mirror as close as possible the S&P Semiconductor Select Industry Index. Expense ratios of 0.35. So that means for every $10,000 you have invested, you would have 0.35. You would have $35 in expenses. Okay, and you have a total of 26 stocks. So this is our smallest one. This is a super concentrated index. There's only 26 equities or 26 stocks here. And so leading the pack, wow, over 25% of the net assets in NVIDIA. Next up, Taiwan Semiconductors, Advanced Microchips Devices, Broadcom, ASML Holdings, Applied Materials, Lam Research, Qualcomm, Intel, and then, of course, Texas Instruments. Between those top 10, that makes up 72.56, so close to 73% just in this top 10 equities. And then what do we get for returns there? So super concentrated had some major results. What's the 1 year in this one? 78% return. And that's largely driven by, frankly, I'm just going to say NVIDIA and Taiwan Semiconductors. 78% return in the 1 year. 3 year blended average would have been 21.65. 5 year blended average was 33.81. So again, that 5 years, 33.81. 10 years of rounded out 27%. But you know what? Look at that. If you bought this and held on to it since 2011, when this fund first started, you would have averaged 25.86. That's blended, of course, but that's frankly phenomenal. 25% on your investment And if you could dollar cost averaging along the way, so investing consistently, you would have had some major results. So now we'll take a look. What if we invested in all four ETFs over a 5-year period consistently to see what the results would have been? It's going to be pretty amazing. Okay, now let's get started. We're going to take it to the spreadsheets and we're going to do an investment account. We're going to say that we invested consistently $550 per month. So that's 550 times 12. All right, $6,600 every year. All right, and then again, as a reminder, we invested in one iShares that had a 1-year high of 46.2 and a 10-year of 15.5. And then the next iShares is a mid-cap 1-year return of 25.63 and then 10-year of 10.35. Then we've got that Spider small cap with 1 year of 17.02 and then 10-year of 8.81. And then finally that Vanik one that had a 1-year huge number of 78%, and then its average 10-year blended was even 27%. So let's see how this would have performed. Whoa, okay. So we would have had invested roughly $33,000, so $6,600 every year. That would have equaled to roughly $33,000, and then we would have had a growth on it of an additional $26,000. So 55% of your balance would be your principal, invested cash, and the rest would be growth, 45% and $26,900. So we'll call it roughly $27,000. That would have been growth. So your balance would have been $59,900. Now let's check it out. Let's see what happens if you move this to 10 years. So again, our blended rates of average returns are different. Look at that. Phenomenal. Actually huge, right? So $66,000 is what you would have invested. That's your principal. And then your total balance would have been $173,000. Now let's take a look at that again. So $66,000, so $6,600 average. So $550 a month average. And then from there, you would have had total growth of $107,900. So 62% of your balance. So more money than you actually invested would have been straight up growth. Now that's the power of compounding interest on your side and good returns. So the combination of consistent investments and solid returns can really lead to some major wealth building. So I hope you enjoyed this review. Hope you found this really helpful, and I hope it inspired you. Now, of course, past results do not guarantee future results, but this gives you a sense of where things could be if you picked good or even great funds and invested in them consistently over the course of time. That's some major money. In 10 years, you've more than doubled your money. Hope you enjoyed this review. Hey, thanks for staying to the end. This video is brought to you by the Next Chapter team. If you enjoyed the video, please drop a comment. Please also like, subscribe, and share for your friends and family. This will help the channel reach out to more people just like you. We offer one-on-one coaching where we work with everyday people to determine a clear path to achieving their financial goals. This includes things like budgeting to reduce debts, planning for big purchases, and even learning how to build wealth with the tools that you have readily available to you. If you're interested, please see our link below to schedule a free call with our team. That's right, it's a free 30-minute call with the team. Also, check out our affiliate links for high yield savings account. This is a great place for the saving up for those big purchases and your emergency fund. Thanks, and see you in the next video.